Imagine waking up tomorrow and finding out your bank is closed. ATMs aren't working, your paycheck hasn't cleared, and the savings you thought were safe suddenly feel like they've vanished into thin air. Sounds extreme, right? But here's the surprising fact. In the past century, more than 500 banks in the United States have failed, and millions of people have been directly affected. The 2008 crisis alone wiped out more than $14 trillion in household wealth. So the question is, what would actually happen if banks collapse tomorrow? Let's break this down. In this video, we're diving into what a modern bank collapse really looks like, how it would ripple through your daily life, why governments rush to step in, and the hidden lessons you can take away today. And stay with me, because later we'll talk about the one factor most people never think about, yet it could make or break your financial stability in a crisis. So, what really happens if banks go down? First, we have to understand the role banks play in your everyday life. It's not just where you keep your money. Banks are the backbone of credit, mortgages, business loans, payroll deposits, and even how governments fund projects. If banks suddenly stop working, the first impact is immediate. Access to your money freezes. Imagine trying to swipe your debit card at the grocery store, only to see transaction denied. That's the kind of shock that spreads panic faster than the actual collapse. But here's something interesting most people forget. In the United States, deposits up to $250,000 per account are insured by the FDIC, a government agency created in 1933 after the Great Depression. That means even if your bank failed, technically your money is protected. The catch? It can take days or even weeks for that insurance process to kick in. And during that time, bills still arrive, businesses still need to pay employees, and families still need groceries. So even though the safety net exists, the immediate chaos is real. Now, think about what happens next. Banks are deeply connected to each other. They don't just hold your deposits. They lend to one another, invest in bonds, and move money through complex systems every second. When one bank goes down, it can trigger what economists call a contagion. That's exactly what we saw in 2008 when Lehman Brothers collapsed. The panic spread so quickly that within weeks, global markets lost trillions in value, and U.S. unemployment shot up from 5% to nearly 10%. People who had nothing to do with Wall Street suddenly lost jobs, homes, and retirement savings. But here's the twist. While a bank collapse feels like a financial story, it's really about trust. Banks run on trust that your money will be there when you need it. If that trust disappears, even healthy banks can suffer because people rush to withdraw cash, creating a classic bank run. And history shows us that fear can move faster than facts. In March 2023, Silicon Valley Bank collapsed in just 48 hours after rumors spread on social media. Nearly $42 billion was withdrawn in a single day. That's the speed of panic in the digital age. So what does that mean for the average person? Let's get practical. If banks collapse tomorrow, here are 3 areas where you'd feel it immediately. First, cash and payments. ATMs would be drained quickly, digital transactions might stall, and small businesses could struggle to accept payments. In a 2017 study by the Federal Reserve, nearly 30% of Americans said they wouldn't be able to cover a $400 emergency without borrowing. Now imagine that same group facing locked-up paychecks or credit cards that don't work. Second, jobs. Businesses rely on banks for payroll and loans. Without that flow, companies may pause operations or delay salaries. During the 2008 crisis, the U.S. lost more than 800,000 jobs in a single month at its peak. That shows how fast things can unravel. Third, confidence in the wider economy. Stock markets react violently to banking shocks because investors fear wider collapse. Retirement accounts, 401ks, and pensions would all take hits, even if you never directly banked with the collapsed institution. But here's where things get fascinating. Most people assume governments can always step in and stop the bleeding. And yes, in 2008, the US government rolled out the $700 billion TARP bailout program. In 2023, regulators guaranteed deposits at Silicon Valley Bank to restore confidence. But there's a deeper question. How many times can governments do this before it creates a new problem, like inflation or taxpayer frustration? And here's the Mythbuster moment. Many believe that in a bank collapse, the rich are safe and the poor suffer most. But in reality, the wealthy often lose big too. Think about businesses that keep tens of millions in payroll accounts. Only the first $250,000 is insured. In the Silicon Valley Bank case, nearly 94% of deposits were uninsured. That's why you saw tech companies scrambling to make sure their employees got paid. So in truth, a collapse cuts across the board. Rich, middle class, or working paycheck to paycheck, everyone feels it. Now, let's look at the bigger ripple effect. If banks collapse tomorrow, credit would dry up. Mortgages, car loans, student loans, suddenly harder to get. Consumer spending, which makes up nearly 70% of the US economy, would drop. And when spending slows, businesses cut back, which leads to more job losses. It's a domino effect that feeds on itself. But before you get too worried, let's loop back to something crucial. History also shows that banking collapses, while scary, tend to spark reforms that make the system stronger. The FDIC was born out of the Great Depression. The Dodd-Frank Act came out of the 2008 crash, adding stress tests for banks to prevent another meltdown. And even though panic spreads quickly today, the safety nets are bigger and faster than they were decades ago. That doesn't mean collapse is impossible, but it does mean that what feels like the end is often the start of a reset. So here's the surprising takeaway. The real power of a bank collapse isn't just in the financial numbers. It's in the way it forces people to rethink trust, money, and security. It shows us how fragile the system can feel, but also how resilient people become when pushed into uncertainty. And that's why the question isn't just, what if banks collapse tomorrow? The better question is, how would we adapt if they did? If you found this breakdown eye-opening, make sure to subscribe for more insights like this.